Hello, today is Sunday, the 31st day of March 2013. On yesterday's video, I did a video regarding the spreadsheet in here and the volatility, which basically this 4.43% volatility over the last month or so is the lowest level since July the 7th, 2003. And within, of course, the comments, I get the question. So it might be once again be a still before the storm. Does low volatility more often precede rising or falling prices? Well, we'll take a look at all the times that we've had the low volatility and well, what occurred afterwards. I was thinking in my local grocery store today, prices are off the hook. All old people spending their social security checks for food, yada yada yada. I actually I'm not going to say 21 hours ago, but 18 or 20 hours ago, I was at a local grocery store, and I just went in there to buy a quick lunch item, and it was pretty much off the charts on how expensive it happened to be. But I really was hardly in there at all anyway. The current daily chart looks like a bearish consolidation pattern. Can you please examine it by pattern also? That's your opinion that it looks like a bearish consolidation pattern. That's not mine. And we're not going to go over the daily chart. We're only going to be going over the daily chart. And this gentleman here sent me a page or some photos. So I'm going to go over one of them right now, actually. And this is the photo that was sent, and it's the monthly chart for silver. It is drawn in a logarithmic scaling, and it has the trend line here and trend line here. They're not parallel lines, but they are both in uptrends. You can see on the drawings that you have blue lines going higher from support areas to resistant areas. Obviously the target is $66. I'm guessing BIS means something buy, but that's by Halloween of 2013. I'm going to be going over my monthly chart and trend line analysis. To me, this trend line isn't the ones that I would be using. There's about 3 or 4 different support ones. This one is close, but not quite. But I just want to go over a few different things within it. You can see here that it did come down to this line as an established level, and it hit this resistance. Now, it didn't come down to this line in here, which is something to point out. And you could have made a point that it did something like that. You have this blue line here, but when you're looking at it at the time, you could have considered maybe it's going to be here. As it breaks above it, it finds support here. And definitely here would have been one area where, well, maybe it's going to go like that as well. So to say that it's going to bottom now because it's at a particular trend, I'm not going to put that in play. In fact, when you got this low volatility movement, I think patience is the key thing because it could take a decent amount of time before the move comes into play. So anyway, as far as different trend lines are concerned, let's go over them. What we're going to do is first look at the very first trend line, and this one is by far not active. And that's right here. You got the connection of the original trend. So if we continue this out further, we can obviously see that it was a significant area that was supported here. Support was not support here. Resistance, and then was unable to find support. Just because it breaks through on the downside doesn't mean it's the end of the market. And that's why I like the key different areas of support to be breaking and establish a pattern of lower highs and lower lows. So that's why this key 26 level is needed to break down to just make that lower low. So other different trend lines as well. The trend line that connects this one, which was the one that he was using. I would personally use the ones again that connects significant lows. You have this one in here. That's maybe later on that might come into play. Then you have one that connects this here, because now you got many key different areas within this rally. You got this low, you got this low, you got this low, and then again here, but it obviously didn't hold as well. And as far as the most ultimate trend, this one here, but currently that's at like 15 right now, or a long ways to go. As far as trend lines on the downside, this one in here I think is it's an area that was broken to the upside, but since it occurred, it has then made another downtrend line. So you can make a case for the descending triangle. There's your straight line. So first you had this, and you can say, oh, it's looking good, it broke it, it's now resisting it. Well, yes and no. I'd rather just make another descending triangle. And again, until this 26 level is taken out, I am not putting this on any bearish level. And even if it does, I'm going to be assuming there's a decent chance it's just another one of these sort of deals, how you break a key level of support and it's just going to recapture it later on again. Okay, so that's it for that chart. Now let's go over the history of the low volatility. 4.43% over a period of 24, 25, 26 periods, which is a little over a month. Let's look back at the history for when we went below it. Now this arrow tells me, are we below this number? And when was the last time on a given date that we had this low volatility? Of course, this goes to March 28th of 2013. And of course, the last one hasn't been since 2003. So what does this usually do in the near term over the last 10 years when it breaks below it? It's never had this situation before, so I don't know. But let's take a look at this back to when this first started. Now, again, just before we get started, I have this 169%. This is just there. I always put this there just to see what the highest was, the highest volatility, and that's what the maximum was, which was played out in 1979, 1980. And of course, if we were to go up 169%, we'd be at about 75. And if we went down with volatility of 169%, we'd probably be about 11. Yeah. Okay, so let's look at the volatility. Let's find the low ones. When we see this number showing a 1, which we see here, then we will see the low volatility. So we're in 1969, the spring, and low volatility started at $1.80. Here it's $1.80 again. We have a lot of zeros, so how did it break the pattern? It broke it to the downside because we can see that it was $1.57. And then it came back up to $1.80, so that's telling you right there that it was a little bit of a failed move at that time. Again, low volatility here again. This time it occurred at $1.88. Here it's ending at $1.84, and again it made another down move. But again, we can see here it's back to $1.84. That down move didn't survive originally again. Again, we got low volatility here, starting at $1.60. And this time it made a small up move, but then back to where it was again. Low volatility again. As now we're going to be approaching the 1972 lows. And there's the low volatility again at $1.60, going down, making those another down move. Of course, there was no uptrend at this time, as silver was just going sideways for quite some time. So now we are in 1972, and we have this low volatility at $1.86, and you instantly had prices going higher. There's moves to like 203, that's about 17 cents, and that's about 8%. And then even again, it goes up to 245. So that low volatility moved into an uptrend, and you can see here that the zeros stay for a while. So it really sustained the rally as it went up to $3.05 here, now up to 6. So obviously that low volatility started a huge rally. And we'll wait for that number again to go into the ones. Now in 1975, low volatility starting at 4.5. And then as we can see, the prices breaking up past 5, that low volatility sparked a bull run that would later sell off. There was a short bout of low volatility here at 442. It really went down again, but then back higher would be the case. Again, low volatility in this point in here. And from 1976 to 79 is when this thing stayed sideways for a long, long period of time. Low volatility at 448 and 77, which sparked higher prices at the time. And then low volatility again at 470. It sparked lower prices. So what does it do? It's either going to go up or down, which is normally the way that charts work. Definitely, of course. But let's continue on further. 77 again in the sideways consolidation, 451. And it broke, well, here's more low volatility. Because when it moves to like 5-6%, it's not really, it almost has to move to like 10% for it to really count. And then the big one in 1979. Let's go to that one now. On January 16th, $6.04. The low volatility started at 602. And this one didn't take long before it went up. You go to 750. And then next thing you know, you break 8. Then you break 9. Then you break 10, 11, and 12. Then you break 18, and so on and so forth. And, well, volatility didn't get big again, or, excuse me, volatility didn't get low again until 1985. As you can see, here's the percentages, 20%, 40%, 20%. Volatility would remain high for quite some time. Even in 84, you're getting 24% volatility. So it didn't get low again until right here in 1985. And this pretty much started a 2-decade run of extreme low volatility. So I'm not going to play too much until this last one because just a whole bunch of nothing happened for about 18 years. So now as far as 2003 is concerned, we'll go to that time frame, and here we are. So this was that low volatility at 465, having a move up to 5, and then again 525, which would sustain the next rally, 650, 7, 8, and so forth. And when we look at this last rally on the last monthly chart, that period was right here. That was the volatility that started that little run. So does this look like a bearish pattern? Well, again, until this breaks down below 26, no. But thank you for tuning in, and have yourself a great day. Bye-bye.